Hi, everyone, and welcome to our Lock Trust Holiday Edition Lunch and Learn 2025 Fintech Year-in-Review, the breakthroughs that mattered. Thank you for joining us during a very busy season. I'm Gidget, your host, and I'm excited to guide today's conversation. We have two incredible voices with us. First, Lock Trust CEO Gina, who will walk us through the major operational and compliance shifts of the year. And from the investment side, we're joined by Jean-Marc, offering macro and venture market perspectives on the trends shaping 2026. Here's what we'll cover today: AI oversight, multi-rail resilience, identity infrastructure, payments modernization, regulatory signals, and lessons from this year's failures. Let's get started.
Thanks,
Hello,
Gidget.
everyone.
2025 was a year where fintech was stress tested, not by theory, but by reality. AI moved from experimentation to real oversight. Cloud outages exposed structural weaknesses. Fraud evolved faster than legacy identity solutions. We saw fintech shift from innovation to accountability. One of the biggest changes this year, AI oversight finally became real. Institutions moved away from AI as a magical black box and into structured, documented, monitored systems. Hybrid compliance, the blend of human judgment and AI scale, became the operating norm.
From the investment side, we saw capital flow toward companies whose AI products could prove reliability, not just promise intelligence. The winners were those who built governance into their architecture from day one.
3 milestones changed the game this year. First, regulators began reviewing AI model governance during exams. Second, institutions publicly disclosed AI-driven compliance errors, a first. And third, real-time monitoring tools became mandatory, not optional.
And investors shifted due diligence accordingly. It wasn't, do you use AI, but can you control it? Governance became just as important as innovation.
In 2025, institutions realized resilience doesn't come from one strong system. It comes from multiple redundant pathways: identity rails, payment rails, cloud paths, routing options. Multi-rail resilience became the standard architecture.
Exactly. The market rewarded companies that could demonstrate uptime independent of any single provider. Investors now view single rail dependencies as a material risk.
We had several high-profile outages this year. Organizations using multi-rail routing saw near zero downtime. Others were offline for hours. Resilience is now defined by your ability to reroute intelligently, not just stay online. Identity was the most disrupted part of fintech this year. Fraud surged in complexity. Legacy KYC showed cracks. Continuous identity and decentralized identity rails showed the strongest performance, something we documented deeply in our global identity infrastructure report.
From the investment lens, identity infrastructure is now viewed as the new payments infrastructure. The companies with strong identity layers became strategic acquisition targets.
We saw architecture evolve fast. Multi-factor identity rails, portable identity tokens, cross-domain trust frameworks. This shift is setting the stage for the next decade of secure financial interaction. Payments modernization kicked into high gear. Instant payments became interoperable. Programmable payments expanded, especially for B2B. More cross-border rails began supporting near real-time settlement.
Capital chased infrastructure with reliability. Speed alone stopped being a differentiator. Reliability, programmability, and identity-linked security became the new competitive edges.
For end users, all of this showed up as better predictability, faster settlement, and fewer exceptions. Behind the scenes, smarter routing and better identity signals did the heavy lifting.
So what's coming next year?
A few clear signals, explainable AI, third-party risk controls, especially for cloud and AI vendors, multi-path resilience requirements, and identity portability standards. Institutions should start preparing now.
And regulation is pushing the investment world toward companies with built-in compliance, not bolt-on compliance. The markets are aligning with the regulators.
2025 had its share of painful failures, cloud outages, automation misfires, identity vulnerabilities, and holiday season routing disruptions, but each one accelerated modernization efforts. Four big lessons emerged. First, over-automation creates blind spots. Second, redundancy isn't optional. Third, identity must evolve as fast as fraud. And lastly, governance must be structured, documented, and orchestrated.
These lessons also separated winners from laggards in the market. Institutions that adapted early are positioned for outsized gains in 2026.
As we head into 2026, expect hybrid compliance to become the default, multi-rail infrastructure to become standard, and identity to become the new competitive edge. AI governance will increasingly be required, not optional.
And from a market standpoint, capital will chase resilience, identity intelligence, and AI explainability. These are no longer future state. They're 2026 expectations.
At Lock Trust, we're focused on enabling this future. Multi-rail identity, resilient routing, AI oversight orchestration, infrastructure built for the next decade of fintech. We're here to make modernization safe, strategic, and scalable.
Thank you for spending part of your day with us.
Wishing everyone a wonderful and joyful holiday season.
And here's to an exciting and resilient 2026 ahead.
We'd love to hear your questions, whether operational, technical, or investment focused. Feel free to drop them into the chat.
Okay, Gina and Jean-Marc, if you're ready, I have a couple questions for you. Gina,
I'm ready.
What were the most impactful fintech breakthroughs of 2025?
Three stood out. AI moving from pilots to production in risk, fraud, and customer service. Real-time payments becoming the default via FedNow and expanded RTP use cases. And three, embedded finance maturity beyond payments into lending, insurance, and treasury within non-financial platforms.
And how did AI meaningfully change financial services this year?
AI shifted from efficiency gains to decision augmentation. Banks deployed explainable AI for credit, AML, LLM co-pilots for ops and compliance, and real-time fraud models that adapt transactions, governments, frameworks improved, enabling safer production.
Awesome. Jean-Marc, what differentiated winning fintech investments from laggards?
I'd say operational discipline, clear paths to profitability, regulatory readiness, diversified distribution, and limited dependency on a single partner. Execution risk outweighed total addressable market and diligence decisions.
Okay. Gina, did real-time payments deliver on their promise?
For the most part, I think they did, especially for payroll, insurance disbursements, and B2B settlements. The biggest unlock was operational readiness, 24/7 liquidity management, fraud controls designed for instant rails, and customer education around irrevocable winning products built real-time decision-making, transaction limits, and customer education directly into flows, especially for B2B gig economy, pay, and insurance disbursement.
Okay, and another one from Steven. What happened with open banking and data sharing?
Good question. Open banking matured from access to outcome. APIs became more reliable and more consistent management improved, and use cases expanded to cash flow underwriting, account-to-account payments, and personalization. The focus shifted to data, quality, and uptime, outperforming most old-fashioned banks.
Okay, and so with that, Jean-Marc, did regulation help or hurt with fintech returns?
I'd say it helped prepare companies. Fintechs with compliance embedded into the product and operations scaled faster and avoided value-destroying surprises. Regulatory maturity became a moat and a valuation driver.
What is the investment stance on digital assets and tokenization?
Price speculation remains discounted. Infrastructure plays gain credibility. Tokenized deposits, settlements, and collateral management that improve speed and capital efficiency without end user volatility exposure definitely helped.
And Gina, one from Stephen for you. How did embedded finance evolve in 2025?
I think it evolved and also showed us the vulnerabilities and the shifts. Embedded finance shifted from monetization experiment to a retention strategy. Fintechs enabled platforms to launch compliant financial products faster, while banks provided balance sheets and regulatory cover. The winners owned the orchestration layer.
So Jean-Marc, with Gina saying that, where did investors see the most risk?
Say hidden compliance gaps and weak fraud controls, especially on instant rails, over-reliance on vendors and unproven autonomous AI decisioning. Operational risk consistently outweighed market risk.
Okay, and I think we have time for two more questions. Gina from Sarah, what fintech trends underperformed our expectations?
Well, we don't want to drop any names on who got in trouble and who got fined, but broad super app strategy struggled in saturated markets and fully autonomous. AI decisioning remained limited by regulatory and trust constraints. These companies are trying to use AI, but not quite there. Focused products with strong unit economics outperformed ambitious, but unfocused platforms.
Right, and Jean-Marc, last questions for you. What's the core investment takeaway from 2025?
I'd say the strongest fintechs now resemble institutions in the making. Durable returns come from companies that turned infrastructure, risk management, and trust into compounding advantages. I think Lock Trust in particular is very well positioned for all of those.
Okay, well, with that being said, Happy New Year and happy holidays, everybody, and we will see you in 2026.
Merry Christmas, everyone.
Happy holidays, everyone.